Welcome to the Nifty Noon podcast.
Glad to be here, diving into all this.
Yeah, and just to set the stage for you listening at home, imagine building your whole reputation as the ultimate, totally tamper-proof source of truth on the internet. And then, you get caught paying influencers to place fake bets on a type-ridden dummy website.
Yeah, not a great look.
No, not at all. So, look, we spent a lot of time reading the news, tracking the markets, and honestly just trying to separate the actual signal from all the absolute noise for you. Our mission today is to take you on a deep dive into the past week's daily articles from our newsletter.
Right, because there was a lot to sort through this week.
Totally. We've gone through the stack, connected the dots, and we're going to give you a super structured look at the week's biggest shifts across crypto, finance, and tech. Because if there's one dominant theme to take away from the past week, it really is this idea of collision.
Yeah, collision is the perfect word for it. I mean, we are watching this fascinating real-time collision between Web3's original native ideals, decentralization, absolute transparency, open protocols, and then the heavy-hitting, super pragmatic realities of institutional and big tech adoption.
It's basically the unstoppable force meeting the highly regulated, deeply capitalized, immovable object.
Exactly.
So to really understand how this is playing out, we're going to walk you through this week exactly as the news broke, tracing this continuous narrative from Monday, June 22nd, all the way to Friday, June 26th, 2026.
Right, covering everything from those Web3 marketing scandals to big tech basically cloning crypto's best ideas.
Yeah, and finally, Wall Street officially giving the green light. So grab a coffee or, wherever you are right now, just settle in. Let's dive into Monday.
Yeah, the week kicked off on Monday with this absolute bombshell Wall Street Journal investigation into Polymarket. And, for a long time now, Polymarket has really been the golden child of the prediction market space. They were the ones proving that decentralized forecasting can actually capture the global zeitgeist.
Yeah, totally.
But the journal uncovered something highly problematic.
I mean, problematic is honestly putting it lightly. According to the report, Polymarket was actually paying social media creators to stage fake wagers and then, celebrate completely fabricated wins.
Yeah, it's wild.
We're talking about $1.9 million in fake bets on these lookalike dummy websites with URLs like polymarket.com spelled with an I.
It's just such a classic, cynical Web 2 deception tactic, but transplanted into a Web 3 company. Yeah. And the scale of it was substantial.
Right. They didn't just do a few of these.
No, over 1,100 videos were produced, generating upwards of 140 million views. But the critical piece here, the thing that really matters, is the target audience. These videos were explicitly targeting U.S. audiences.
Which is a glaring legal issue.
Very much so. Because,
as we know, Polymarket has been explicitly barred from operating onshore in the U.S. since their 2022 settlement with the CFTC. Okay, let's unpack this because, this whole situation, it's like a famous farm-to-table restaurant, right? A place that builds its entire brand on transparent local sourcing, and then they get caught buying their vegetables out the back door of a massive discount supermarket.
That's actually a great way to put it.
Right. In an industry built on public ledgers, which are supposed to be the ultimate source of truth, relying on these deceptive, Web 2 style growth hacks is just a really tough pill to swallow.
It really is. It's a significant reputational hit. But, and I think this is important, this is where we have to separate the marketing behavior from the underlying technological architecture.
Right, the tech itself.
Exactly. Because what is vital to understand here is that the actual real trades occurring on Polymarket are still settling transparently via the Polygon blockchain. They are still utilizing decentralized oracles to resolve those market outcomes. So the core mechanism isn't broken. It's just the growth strategy that was deeply flawed.
Wait, let's pause there for a second, because for those listening who maybe aren't deep in the technical weeds, an oracle sounds like something straight out of a fantasy novel.
Right, yeah.
What does a decentralized oracle actually do in this context?
So think of an oracle as the bridge that feeds real-world data into the blockchain.
Okay, a bridge.
Yeah, because a blockchain is basically a closed mathematical system. It doesn't watch the news. It has no idea who won an election or what the temperature is in New York.
It's totally blind to the outside world.
Exactly.
Right.
So the oracle is this network of independent validators who verify real-world outcomes and feed that data on-chain. If they report the truth, they earn fees. If they lie, the system automatically penalizes them financially.
Oh, wow. So they have skin in the game.
They do.
Yeah.
So the resolution of these bets on Polymarket is still governed by trustless math, not by some central authority in a back room.
Okay, so the take is sound, but man, the timing of this marketing scandal just couldn't be worse for them. I mean, they are actively trying to come back onshore to fight regulated rivals like Kalshi on their home turf.
That is the core of it, yeah. This regulatory hurdle, compounded by recent state-level crackdowns. We saw this in places like Kentucky and Minnesota recently. It's going to temporarily stunt Polymarket's momentum.
Yeah, it has to.
But the fundamental demand for permissionless, truth-seeking markets, that remains entirely intact. People want to trade on outcomes. Authentic transparency will ultimately win out over bad marketing.
Yeah, and Polymarket seemed to realize they needed to get back to reality super quickly because by Tuesday they updated their FAQ to explicitly state they have no token and absolutely no announced airdrop plans.
Yeah, they had to shut that narrative down.
Definitely poured cold water on all the airdrop farmers. But, while the application layer was dealing with that whole marketing mess, the underlying base layer of the internet was making incredibly serious moves.
Right, because Tuesday brought a major structural shift for Ethereum. 5 former senior Ethereum Foundation researchers, including some really prominent names like Ansgar Dietrichs and Barnaby Molnar, officially launched a new entity called Ethlabs.
And just to be clear, this isn't just some small startup. Ethlabs is an independent, nonprofit R&D lab backed by absolute heavyweights.
Huge heavyweights.
Yeah, we're talking anchor funding from Bitmine, SharpLink, and Joe Lubin, the founder of Consensus. Their mission is to push Ethereum to become the universal settlement layer of the global economy, focusing super heavily on scaling and faster settlement.
Exactly.
But wait, hold on. That doesn't really track with some other news we saw earlier in the week in the newsletter. Because Vitalik just announced that the Ethereum Foundation is actively cutting its budget by about 40% to transition into a long-term endowment organization.
Yeah, that did happen.
So I have to push back here. If the mothership is cutting funding and shrinking its footprint, how does spinning off a well-funded independent lab actually help Ethereum become the global settlement layer? It just feels counterintuitive.
I get that. It seems that way until you look at how decentralized networks actually mature. What's fascinating here is that this perfectly aligns with Ethereum's new framework for decentralized stewardship.
Decentralized stewardship. Okay, break that down for us.
Well, think about how a protocol scales to a truly global level. If every core upgrade, every piece of vital R&D is funneled through one central foundation, that foundation eventually becomes a massive bottleneck.
Right.
And worse than that, it becomes a central point of failure, both technically and, frankly, politically. By moving elite core technical talent outside the foundation into independent, well-funded hubs like Ethlabs, the network actually maintains its credible neutrality.
Meaning no single entity can be accused of overly influencing the network's direction.
You've hit the nail on the head. It preserves censorship resistance. If you are an institutional capital allocator, or say you are designing large-scale agentic networks like AI systems transacting on-chain, you need absolute assurance that the base layer cannot be captured or pressured by a single state actor leaning on a single foundation.
Right. They need guarantees it's not controlled by just one group.
Exactly. So empowering dedicated nodes of independent builders prepares the whole ecosystem for massive institutional adoption without a central bottleneck. The mothership isn't abandoning the mission, it is distributing the command structure to make it essentially unkillable.
Okay, that makes a lot of sense when you put it like that. So we have Polymarket proving there is this mainstream appetite for prediction markets, and then Ethereum decentralizing its core R&D to prepare for global scale. And then right on cue, by Wednesday, big tech smells blood in the water.
They certainly do.
Yeah, a major report by Frank Shaparo revealed that Meta, yes, Mark Zuckerberg's Meta, is developing a standalone prediction market app internally dubbed Arena.
Right, Mark Zuckerberg building a prediction market.
It's crazy. And Arena is reportedly going to operate entirely separately from Facebook and Instagram. The report suggests it will initially use this, video game-like points system rather than real capital, but inside sources say they haven't ruled out real money wagering down the line.
It is a really revealing development. I mean, it highlights just how closely traditional tech is monitoring the consumer engagement pioneered by decentralized Web3 platforms.
Here's where it gets really interesting, though. It feels almost predatory in a very smart corporate way. Like Meta is basically operating like a giant corporate focus group.
Yeah, that's exactly what it is.
They let the crypto-native platforms take all the regulatory arrows right, figure out the user interface, prove the product market fit, and get totally beat up by the CFTC. Then, once the concept is completely proven, Meta swoops in to gamify the mechanics in a sanitized, highly regulated sandbox for the masses.
That is the traditional Silicon Valley playbook right there.
Yeah.
But we need to look at the broader implications for the crypto industry as a whole. Because on one hand, yes, it is a legacy giant attempting to co-opt a Web3 innovation. But on the other hand, this is the ultimate validation for the concept of event contracts and crowdsourced forecasting.
Right. Validation at an unprecedented scale.
Exactly. If Arena launches and actually succeeds, Meta could accidentally act as the greatest onboarding funnel in history. They could introduce millions of everyday users to the basic mechanics of probability trading.
But using meaningless points, right?
Right. But let's think about the psychology there. What happens when a user gets really, really good at predicting outcomes using those points?
They're going to want to make real money.
Yes. They realize the limitations of a closed, sanitized system where the house controls all the rules. Human nature dictates they will eventually want real skin in the game, with actual global liquidity and zero risk of the platform arbitrarily changing the payout structure on them.
Yeah, that makes sense.
So that natural progression will likely drive a massive wave of sophisticated users straight out of Meta's walled garden and right into the robust, transparent frameworks offered by native crypto platforms. Meta might literally just be building the ultimate training wheels for Web3.
Creating wheels for Web3. I actually love that perspective. And speaking of legacy institutions stepping into the arena, that takes us right into Thursday's news. Because if Meta is trying to onboard retail users to the application layer, Wall Street just formally validated the absolute bedrock of the whole crypto asset class.
The BlackRock report.
Yes.
This was perhaps the most structurally significant piece of news all week. BlackRock, literally the world's largest asset manager, released a research paper titled Sizing Bitcoin in Portfolios. They didn't just discuss it theoretically and, as a concept.
Right, they gave actionable advice.
They officially recommended that conservative financial advisors and institutional allocators maintain a 1% to 2% Bitcoin position in diversified portfolios.
A formal recommendation from BlackRock. I mean, according to the details we had in our newsletter, BlackRock is framing Bitcoin as a complementary diversifier.
Yeah.
And because of its low historical correlation with traditional stocks and bonds, they mathematically proved that a 1 to 2% allocation adds only 2% to 5% of total portfolio risk. They actually compared the risk profile directly to holding a single Magnificent Seven tech stock.
That comparison is the key to all of this. They aren't out here saying Bitcoin is going to go up forever. They are saying, here is the exact mathematical risk budgeting framework for this specific asset.
Right, but I have to bring in a harsh reality check here from the newsletter. Because U.S. Bitcoin ETFs just saw a record $6.4 billion in outflows over the last 30 days.
Yeah, they did.
It was the largest 30-day outflow on record. And at the time of this news, the price of Bitcoin was slipping under $60K. So what does this all mean? How can BlackRock publish a paper telling conservative advisors to allocate capital with a straight face while the market is actively bleeding and their own ETFs are seeing massive outflows?
Because you have to separate short-term trader capitulation from the actual psychology of traditional finance.
Okay, explain that.
The ETF outflows, the immediate price dipping under 60K that is just market noise driven by macroeconomic factors.
Right.
I mean, we saw the NASDAQ drop 3% that same week. Short-term traders flee when things get volatile. That's what they do.
Right.
But what BlackRock is doing with this paper is providing something far more valuable to a wealth manager than short-term yield. They are providing career cover.
Career cover. Okay, unpack that for us.
Well, think about what a fiduciary or a conservative wealth manager actually cares about at the end of the day. They care about not getting fired.
Yeah, true.
For years, the conversation between wealth managers and their compliance boards was, is crypto a scam? Is it a fad? A wealth manager wouldn't touch it because if it failed, they looked foolish and they lost their job.
The career risk was just way too high.
Yes, exactly. But BlackRock has ended that debate. They have shifted the conversation from a philosophical debate into a calibrated mathematical equation of risk management.
Wow.
By proving that adding a volatile, non-correlated asset actually improves the risk-adjusted returns of a standard portfolio, they are handing wealth managers this exact compliance-friendly vocabulary.
They don't have to defend the philosophy anymore.
Right. When an advisor has to explain why they're buying Bitcoin, they no longer have to talk about decentralization or Austrian economics or inflation hedges. They literally just hand the compliance officer the BlackRock paper and say, it's a complementary diversifier that adds marginal portfolio risk equivalent to holding Apple.
That is so smart.
When BlackRock gives you the math, you can't get fired for buying Bitcoin. This entirely collapses the operational friction for institutional adoption. The short-term ETF outflows are just noise compared to this massive structural rewiring.
That is a fascinating insight. The philosophical debate is over. It's just math now.
Which brings us perfectly to the final piece of the puzzle on Friday. Because if Wall Street is reallocating trillions in traditional portfolios and big tech is getting ready to onboard all these retail users, the underlying financial plumbing, the actual way digital dollars move around needs to be flawless.
Absolutely. And that plumbing requires deep, unified liquidity, which is exactly what Friday's news addressed. Spark and Uniswap announced this major partnership to launch the FX Layer.
Right, the FX Layer. This is a shared stablecoin swap pool built on Uniswap V4, and Spark seeded it with $150 million from their USDS ecosystem to establish this foundational liquidity base that supports USDS, Tether's USDT, and PayPal's PYUSD.
To really understand why this is critical, we have to look at the current state of stablecoins, because right now, every single bank, fintech, or payment provider basically wants to issue their own stablecoin. They all want their own proprietary digital dollar, right? So if I hold, let's say, a Chase digital dollar, and you hold a Bank of America digital dollar, how does the math actually swap them without one of us losing value?
That is the core problem right there. If every institution builds their own isolated liquidity pool and their own separate market-making operation, you get severe liquidity fragmentation.
Right, it's all chopped up.
Exactly. And when liquidity is fragmented, there just aren't enough assets in any single pool to facilitate large trades. So if you try to swap Bank A's stablecoin for Bank B's stablecoin, you suffer from terrible slippage. You put in $1, and you only get 98 cents out because the pool is just too shallow to absorb the trade efficiently.
Okay, so this is basically an adapter problem. It's like traveling to Europe and realizing your phone charger won't fit the wall, right? Spark is trying to build a universal adapter for all these different digital dollars.
Close, but they aren't just building an adapter. By putting it on Uniswap V4, they are standardizing the actual outlet itself so anyone can just plug straight in.
Oh, interesting.
Yeah, let me walk you through how automated market makers handle this. Uniswap V4 introduces programmable hooks. So instead of every bank having to write complex custom code to swap their specific token, the FX layer provides a shared, programmable architecture.
All right.
Any institution can plug their stablecoin directly into this shared liquidity pool. The math is centralized in one smart contract, which deepens the pool massively and totally eliminates that slippage we talked about.
That makes total sense. And this brings us to a vital statistic from our newsletter that really drives this home. Because the Boston Consulting Group recently projected that stablecoin payments will hit somewhere between $350 billion to $550 billion by 2025.
That is a staggering amount of volume.
Yeah.
And the truth is, the current fragmented infrastructure simply cannot handle that impending growth.
It would just break.
Right. The FX layer is the exact type of capital-efficient, multi-issuer infrastructure required to handle hundreds of billions in daily swap volume without breaking down. Spark coordinates the governance and the initial capital, while Uniswap provides the decentralized, programmable architecture. It is a completely proactive solution to prevent the system from just clogging up when these non-crypto native institutions start moving massive capital on-chain.
It really feels like all the pieces are finally snapping together. We've covered a ton of ground across this timeline today, from prediction markets struggling with their Web 2 marketing to the base layer R&D decentralizing, big tech creating onboarding funnels, Wall Street providing that career cover for allocators, and stablecoin plumbing standardizing the outlets.
We really have.
So help us pull this all together. What is the real synthesis here for the listener?
The key to understanding this entire week is differentiating between the noise and the structural foundation being laid beneath it.
Okay, so what should we classify as just noise?
The noise was the $1.2 billion in crypto longs that were wiped out in liquidations. The noise was those short-term ETF outflows we saw.
Yeah.
And frankly, the noise was Polymarket's desperate Web 2 style marketing tactics trying to artificially inflate their U.S. presence.
Yeah.
That is all surface level, immediate volatility.
And the structure, what actually matters long term.
The structure is what will dictate the next decade. It is Ethlabs spinning out top-tier researchers to ensure Ethereum scales without losing its credible neutrality. It is Spark and Uniswap proactively building the FX layer to prevent a stablecoin liquidity crisis before it ever happens.
Right.
And most importantly, it is BlackRock providing the institutional math required to greenlight trillions of dollars of traditional capital into the space. The foundation is being reinforced at every single layer of the technology stack.
It is an incredibly compelling picture when you zoom out like that. And looking ahead to next week, based on what we've seen, the key narrative for you to watch is this dynamic with big tech. Keep a very close eye on how traditional tech companies like Meta attempt to sanitize, sandbox, and ultimately monetize crypto-native concepts, because prediction markets are really just the beginning.
Indeed they are. And I think that leaves us with the final, rather provocative thought for you to mull over.
Let's hear it.
We are watching BlackRock dictate the portfolio theory for Bitcoin. We are watching Meta clone prediction markets. We are seeing major fintechs plug their stablecoins into Uniswap. It raises a really important question. Are we rapidly approaching a future where crypto just ceases to exist as a distinct, separate industry?
Wow, yeah.
Does it simply disappear into the background, becoming the invisible, ubiquitous back-end software that powers both Wall Street and Silicon Valley?
The invisible back end of the global economy. That is a thought that will definitely stick with you. If you want to keep tracking these shifts and stay ahead of the noise, make sure you are subscribed to our newsletter. Thank you so much for joining us on this deep dive. You can find all the articles we discussed today and follow us for more insights by checking out Nifty Noon on X and Substack. Until next time, keep looking past the noise, and we'll see you on the next deep dive.